Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So we're back at it after last week's hiatus. Hopefully everyone had a fun Easter or just spring break, depending on timing. And now we're back to some of that the EIA data and what do we think is going to continue to happen as we progress through this little bit of a lull period. But then obviously we're heading into summer driving season. What does that mean, and how does OPEC change things given the fact that they've announced their cut? And then tomorrow we're going to do our econ show, and we're going to go deeper into some of the Chinese data. Where is it good, where is it bad, and now, for anyone that's been following us, we've been following a lot of this data, and if you have, then you can kind of look at the numbers and be like, I'm not sure how true some of these numbers are. But again, we'll dive into that. So just to give you a breakdown, in the first segment, we're going to look at activity, which is tracking along pretty much seasonal norms when you look at the flows up and down. And then in the segment 2, we're going to look at that post Easter lull that we've been talking about, and we want to look at, okay, well, here's the lull, where's the bounce, where are we going from here? And then in the last segment, we want to look at how the OPEC Plus shifts some of these estimates, some of these flows, some of the different OSPs and crack spreads, because that's going to be an important part. And the question is always, well, did OPEC see the slowdown in demand and act accordingly, or did they create the slowdown or did they create the demand slowdown? And it's a bit of a chicken and the egg. It's probably the answer is both in different ways, and we want to go through that in more detail in segment 3. So just looking at some of the data, overall the surplus for total oil and product stocks, the surplus widened from 34.4 to 60. A lot of that is just because of the crude that was on floating storage, which has come on shore, and then we've had some builds increasing on the product side, which we're going to talk about in more detail. Crude, land and floating, surplus widened from 40.5 to 53.5. Again, just based on timing. A lot of that was driven based on floating storage. We want to break that down in terms of the different pieces as we go into segment 3. Total oil product stockpiles, the surplus went from 6.1 to 6.4. So again, you're still seeing some of that increase. And we want to talk about where we're seeing those builds and how that's going to accelerate as we go forward. Exxon, they is facing a strike with some of their units. So in Nigeria, where they declared force majeure on 2 loadings so far. The question is going to be, do they get this figured out ahead of time? Now, one of the other key pieces that we want to look at, so Iraq, so Baghdad and Kurdistan have technically come to some sort of temporary deal with that Kurdish region. But the issue is back pay from Turkey, which is essentially $1.5 billion. And there's still not moving crude through there, which is, again, adjusting some of these different flows. We've seen a big increase in flow. Well, I shouldn't say big increase, but a sizable, amount remaining firm coming from the U.S. going into Europe, again, trying to supplement some of that CN crude, which is going to be a key part to watch as we go through the coming months. And really, where do we see some of the flows, and where does Iraq fall in some of the estimates when you look at some of those production cuts that were discussed and talked about, and then realistically agreed upon as we head into May. So we look at total land storage, the deficit narrowed from 16.4 to 14.1. So still kind of hugging where we were on the season, on the average. That's something that we think is going to be persistent. Land storage west of Suez, the deficit widened from 2.7 to 4.8. And now that's going to reverse when you look at some of the shifts that we're seeing in Europe. So again, ARA is going to be a bigger, but again, bigger shift. It's just going to be right in line with the average. So it's not too much one way or the other. And then east of Suez, the deficit narrowed from 13.7 to 9.3, but we're seeing a bit more of that building when you factor in China. Now, when we look at floating storage, the surplus narrowed from 50.2 to 23.8. So we had that big spike. Now you're coming back down, but you still see we're still very much at the higher end. And a lot of that is west of Suez. The surplus narrowed from 19.8 to 9.3. with a chunk of that being Europe, which is why I was saying the ARA side, it's a lot of that is going to go from floating back on shore. So there's going to be some of that back and forth. And then east of Suez, the surplus narrowed from 24.5 to 13.5 with a piece of that, or a large part of that, being Asia, normalizing a bit because Middle East continues to see increases in floating storage. So now we look at the U.S. U.S. had a drop of 4.58 million barrels. When you factor in the SPR, it was a drop of 6.19. Again, there's still some that was already scheduled. The rest of that should be canceled for the rest of the year, but that was something that had to go before Congress. Here you can see that Pad 2 still had a drop of 1.35 million, Cushing a drop of just over a million. In Pad 2 had a fall of 2.21, but as you can see, Pad 3 is still well above the 5-year, well above year over year. So we still have an elevated amount in Pad 3. And then the I don't want to say shortage, but the lower level in Pad 2 is going to keep those flows from Canada coming straight down without much issue at this point in time, because it's going to be supported. And then if you look at crude, excluding SPR, you can see that it's fairly normal. The rate of change is very much in line with what has happened previously, especially when you look at 2021. When you look at 2019, in terms of that rate of change, typically you have a bit of a draw, then you have a little bit of a flatlining, if you will, as you get to the end of April, beginning of May. And that's what we were talking about, where we're in this lull period now of April activity has come to an end now that the last of spring break, typically with Easter. And then then you get that pickup, obviously, as we go into Memorial Day weekend, and those are going to be those shifts in that gap in between. So again, still something very normal. And then when you factor in storage and oil storage and crude products, you can see that in terms of that rate of change, we had that drop, and now we're just flatlining a bit. And typically, when you look at some of these levels, we're just assuming, and our bet is that this just goes sideways. So we're a little bit lower, but typically when not against last year, yet last year versus last year, we're much higher. But at this point, we see this just going flat and staying fairly stable at this point in time, and it'll merge with some of these other areas as you get into that June and July area, because we still see demand not really getting back to the same levels that we've seen in previous years. So when you look at Pad 3, again, you could see very elevated. We're coming right in where that 2020 area took off, because remember we had the lockdowns, the shutdowns, so that was when you had these big builds. So we're still, again, third highest ever in Pad 3. So there's still more than enough that can be moved into Europe without seeing any impact, even as U.S. crude refiners come back from the kind of that Easter slowdown, and they're going to keep climbing higher. So when you start looking at Cushing, typically we have a bit of a draw here when you look at some previous years, and then flatlining. And because of the flows and the delays between what comes down from Canada, what's going into the water, we're going to see this stay at the lower level just because that demand is there for exports, and that'll flow down into the Permian. Into the Houston Ship Channel, and that's going to keep this on the lower end. Even though there'll be flows down from Canada, there's still going to be that running at lower levels. Runs. As we were saying last week, we figured that 89 to 91.5 is kind of where we should be given the time of year. So last week we got down to 89.3. Now we're back up to 91%, and now we're going to have that steady climb from this point out. And again, not like we're going to 97%, but going from 91 to 93% is very normal for this time of year, and we'll look at that chart in a minute, and you can see it'll likely be driven by Pad 2, a bit of Pad 3, and Pad 5. And when you look at some of that activity, again, you can see how we kind of have a little bit of a run, then you go a bit sideways, and then you start to get some of those movements. So, but again, between 91, 93%, and you can see the general trend is going to increase until you get to about the end of July, realistically middle of August, and then you start to see those declines into September and October along those seasonal, not economic run cuts, but maintenance run cuts that typically roll out. But we should see this steady increase. And so but we're going to stay at the higher end. So between 91 and 93% is kind of where we're going to be over the next few weeks. Imports were up 100,000 barrels a day. It was driven by Pad 3. Pad 3, remember we said, was running on the lower end, so this is a nice bump. Pad 2, we said, was going to waffle back and forth, but again, stay strong above the 5-year average. That's going to continue. And Pad 5 will stay lumpy, but you can see it's still well above the 5-year, even though it declined 167,000 barrels a day, still fairly strong, and that's going to be the case as we go into summer driving. Imports into Pad 3, one of the things that we've been saying is it's going to stay below the 5-year average, but stay a bit closer to it than it has in previous year and in the last few years, just because we're going to need that heavier crude. We're going to the distillate market is still there for us, but shrinking rapidly. And that's something that we want to talk about in terms of crack spreads, because the crack spreads are weakening in a significant way, which is going to be a big problem. The U.S. is going to have opportunities. Pad 2 will be better than Pad 3. Pad 3 is going to struggle, just because we're seeing more of this Asian product, especially Chinese product, hitting the market, Russian product hitting the market, and taking a lot of this market share when you look at Latin America, when you look at Africa, which is keeping European products kind of capped and is going to put some pressure on the U.S. But realistically, which is why we're still going to see crude imports remain below the 5-year average, but just stay, middle of the cloud, a little bit closer to that 5-year period. So now when we look at Pad 2, based on the economics, as we were saying, it's going to stay above the 5-year average. We're still going to average strong. That's going to remain the case in general. When we look at implied demand, gasoline dropped 417,000 barrels a day. It went from 8.9 to 8.5. If you remember, we were saying that we were going to get to about that 8.4, 8.5 level. That's the lull. Now we're going to get a nice little bounce, and the bounce should put us closer to about 8.6, likely 8.7. And then we're going to hang out at that 8.6, 8.7 level. And it'll all be weather dependent. How rainy is it? What's the weather look like? And then we'll go there. And as the weather improves, you'll start to creep back towards that 8.9 million barrel a day. Distillate continues to be weak. We don't see it adjusting too much one way or the other. Jet had a nice bounce. That's a lot of that refill following some of the demand that we saw for Easter. So we're still going to see that 1.45, 1.55 is the average. And then propane, propylene weakened, fell 106,000 barrels a day. But again, that's just a bit of seasonal, just because we're in that lull between planting and everything else. So again, not too much there. When we look at implied demand for gasoline, you could see that there's, we had, because Easter was a little bit earlier, you could see that we had that nice little spike, which is similar to other periods we've seen. Then you see the drop down. But the drop, as you can see, just go looking at the last 10 years, is fairly elevated. So to see us get to 8.6, 8.7 is still putting us at the lower end of where we normally sit. And that's when you start looking at the data. You can see that typically we go sideways for April, and you'll get that spikes up and down, and a lot of those spikes are going to be driven based on what is happening for Memorial Day. Where does it fall, early or late? And again, that's where we continue to see. But as we average it out, one of the things that we've been talking about is how it's leaning towards the lower end. Supply of crude remains fine, nothing one way or the other. Gasoline storage, as you can see, there's normally that it's rate of change wise, it's moving almost perfectly in a seasonal norm, just at a marked reduction lower. And a lot of this is driven because of the limited imports coming from Europe. So you see that flatlining in general. And then when you look at the other years, we typically just go sideways from here until we get towards, really that the end of June, because typically you'll see some of these bills, you'll start to see some of this normalize. So really not too much to say one way or the other. Just it's at the lower end of storage given the last couple of years, but there's so much gasoline just sitting in the market, and as you start to see some of those exports slow, it's going to get stuck and then again push further, and that's why we do see builds in gasoline accelerating. But there's a lot of there's a lot of space. So even if we move along those 2019 lines, we're just going to go back to what is normal. So there's still some of that gap that is available, but this is going to put pressure on crack spreads. This is going to hurt some of the coastal refiner guys, which is going to be a bit of a bigger problem. Distillate, flatlining, again, still at a lower end, so that's going to be one to watch. But as you get some of that demand loss, both seasonal and just because of the shifts of Russian diesel and Chinese diesel, that's going to put a bit more into storage. And then jet continues to climb, so it's just going to be a matter of, okay, well, what can be left in the disty pool, what goes into the jet kerosene pool, and that's going to be an important one. As you can see, in terms of the curve, not much change, slight backwardation, but we're starting to get kind of flat pricing. At this point, you should start to see a little bit of contango form, just given today's action, but still not too much to say on the curve side. And then floating storage has come down, so we'll see this balance out because we had imports will drop down, then we'll get some floating storage build back up, and that balancing act will continue to play out. So that's what we have for you on this side. The next segment, we're going to go deeper into refined products and what are some of the pieces that are happening on the following Easter, and how are we setting up into summer.